Hello and welcome to yet another instalment of our Nucleus Wealth Insights series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. Sitting across from me, we have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, also the founder of internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business financial blog. We also have Leith van Onselen, our resident Nucleus Wealth economist, who has spent time with both the federal and Victorian treasuries, along with some time as an analyst with Goldman Sachs. Leith now co-authors the widely read Macro Business financial blog with David Llewellyn-Smith. And finally, we have Nucleus Wealth's head of investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy, and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, of course, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to our next instalment of Nucleus Insights, which we've entitled Australian Housing, Boom and Doom, or Boom to Doom potentially as well. We'll find out at the other end of today's presentation. I'm sitting here, of course, with the big three, with Damien, Leith and David. So we've got a full house today. We've got a number of graphs, as always, with Leith's work. So if you're listening in on a podcast, please feel free to head over to our site and grab the PDF of the graphs as well, if need be. So we'll jump into the agenda today. So we're going to have a national overview, pretty much just taking off from continuing on, from where our last housing special left off. We're going to focus on Australia's major city there, Sydney, and also look at Melbourne as well. We'll have a look at some government policy responses to the housing boom and potential doom. Have a look into the future of what's next for property prices in Australia. And then, of course, as always, we'll wrap up with investment implications and how we use this information and in the ways that we do to position our portfolios every day here at Nucleus Wealth. So I'll hand over to our resident chief economist, Leith van Onselen. G'day, Leith.
G'day, Tim. G'day, everyone. I apologise to everyone. There's going to be a lot of charts. That's what I do. Look, the purpose of this presentation is to basically give a state of play of where the Australian housing market is now currently. A couple of months ago, we did one on a different sort of one on the housing market, which kind of gave you the history of where we've come from and how valuations rate historically and that kind of thing. So you can check that one out if you want more of a historical perspective. But the first chart we've got here, this is the quarterly dwelling price growth, current as of yesterday, which is the 18th of July, which comes from CoreLogic. And what it shows is the quarterly value growth across the 5 major markets as well as nationally. And what it shows is that 3 of the 5 major markets, that's Sydney, Melbourne and Perth, are all currently in the red. Nationally, house prices have fallen by about 1% in the last quarter. Sydney's down 1%, Perth's down 1.1%. But the big surprise is Melbourne's actually leading the price falls at the moment, and Melbourne's fallen by 1.6% over the most recent quarter. So yeah, there's a lot of slowdown going on. If we skip across the next chart, we've got the same chart here, but this actually shows the annual change in dwelling price growth across these same markets. And again, as you can see, pretty much every market bar Adelaide are now all experiencing either falling trend growth or negative price growth. Sydney's leading the way. Sydney's house prices are down 5% over the past 12 months. Perth's are down 2.1%. Melbourne's barely positive but falling fast. And nationally we're down 2.2%. And only Brisbane and Adelaide are showing any growth, although Brisbane's price growth is also falling. So it's a pretty negative picture. And the housing market so far this year has slowed down fairly abruptly. So far from peak, from the most recent peak, national values are down 2.6%, led by Sydney, which has fallen by 5.1%, and Melbourne that's down 2.5%. And Perth's values, as we know, have been falling for a number of years, and Perth's actually down about 12% from peak.
Wow.
So we're looking at a pretty sizable correction there, and Perth's values have actually, Perth's rents have actually fallen by about a quarter as well, so they've got a double banger going on.
It's probably, what, 20% in real terms in Perth? Or
yeah, probably about that. It has been a number of years Perth's been falling, so once you factor in inflation, it's probably looking at more like 20%, and I believe there's more to come. Skipping along to the next chart. Now, I'm going to break down a few different metrics here just to sort of give you an idea about how the overall housing market's going. This next chart, I've got a chart of actual dwelling sales, so the volume of sales across the 5 major markets, which comes from CoreLogic. And what this chart shows is that the volume of sales is crashing, and it's almost hit the levels that we saw in the depth of the 2011-2012 bear market, and it's close to the lowest level in 20 years. Sales have fallen about 1/4 or 24% since July 2015. And as I said, they're now tracking near 20-year lows. So it's not just prices, it's also volumes that are falling.
Price tends to follow volume too.
That's right, yeah. You see that later on. I'll actually track prices against volumes, and there's a very, very strong correlation.
Okay, sure thing. And so auction clearances?
Yeah, same thing again.
Actually, sorry, can we just jump back to that just 1 sec?
Sure.
And then so the
Damien.
The new builds, what are they running at?
I cover that actually later. But
relative to this, so
new builds are running at about 190,000.
190. So ballpark, and that's a pretty significant high. So ballpark, I guess, that if you actually separated new builds away from existing, then there's tiny, I guess, in terms of the actual number of existing. Does that make sense? Sorry, what I'm trying to get to is if you took away the 190 from that, just to say, well, there's a proportion of houses that are coming out that are new builds that almost have to be sold.
Yeah.
And then there's the next set of houses, which is the parts that's the transactional part about people actually buying and selling, and so that looks like that's going to be even significantly.
Yeah, that's right. Yeah, well, yeah,
70,000.
I get where you're at. So if actual sales are running about 260,000, we've got new builds of about 190. So when I say new builds, that's the net additions. So
right.
That's basically net addition to the dwelling stock, because when they build new properties, they often demolish old ones. So there's not actually a net supply increase. But yeah, so that's running about 190. So established housing is probably falling a lot heavier than that, although I haven't tracked it. And again, this is only at the 5 capital city level, not nationally. So nationally, it's even the overall sales volume is a bit higher again.
But I guess jumping into the auction clearances again, but the auction clearances is the secondary market, isn't it? You typically don't find new builds being auctioned.
Yeah, that's right. Although auctions only account for a very small proportion of overall sales. It's only about 25%. So
right.
And really only in Melbourne, and to a less extent Sydney. Melbourne's the auction king, but even then, I think it's only about 1/4 of total sales. So yeah, it's a secondary indicator, but auction clearance rates have also crashed. So we've got auction clearances running at about, in the low 50% range, actually in the 40s in Sydney, so about mid 40s in Sydney, and this is down from around 70% the same time last year. So we're looking at a pretty heavy decline in auction clearance rates, as well as prices and obviously sales.
Okay, very good. And jumping across into finance.
Yeah, look, housing finance growth is again falling. Pretty much all the indicators are falling at the moment. So the annual growth in housing finance is about to turn negative after running at about 15 to 20% growth per annum during the boom. And this has been driven by falling investor finance growth. So investor finance has fallen by 7% in the year to May, which is the most recent, and that's a massive change. So that's negative 7% growth, so falling 7%, which is versus growth of between 20 and 40% during the boom. So investor finance is crashing through the floor, and as we'll see later on, that's one of the big indicators for house prices.
Sure. Okay. What's the percentage of investors in the market these days? I remember it was quite high.
It's about 40. It's about 40 nationally, 38 to 40%. It's much higher in Sydney. So Sydney got to about 60%. It's now I think about 55%. Melbourne's
so
about
half
45.
half the housing market.
That's right. Yeah, pretty much. Yeah. So I mean, as I'll show later on, when we focus in on Sydney, it's having a pretty detrimental impact.
Sure.
And actually chart the growth versus investors there, and you'll see what I'm talking about.
Okay, sure thing. We'll jump across a bit of a hot topic with a lot of people, and particularly if you live in Melbourne and Sydney, is foreign buyers.
Yeah, pretty much so. As I said, everything's falling. So pretty much all the indicators are falling, and foreign buyers, home buyers, is no exception. Now, I'll just say from the outset, we don't have any hard data on this. The best we can get is survey data, which comes from NAB, and ANZ does a similar one, which shows similar statistics. But this is just one chart from NAB, which shows the demand for established property from foreign buyers. And as you can see, it's fallen across the board, but it's fallen particularly hard across Victoria, which is really Melbourne, and New South Wales. So at the height of the boom, the foreign buying boom, there was 15% of established sales apparently were going to foreign buyers, whereas now it's about 6%. So that's just the established market. And
no thanks to the Australian government.
That's right. Yeah. Look, yeah. I mean, you probably thank the Chinese authorities more than anything. But look, again, it's just another indicator. We've got all these indicators, and they're all sort of showing the same kind of thing. Everything's down: prices, auction clearance rate, sales, foreign buyers, finance, etc.
Okay. What about supply?
Yeah, supply's actually pretty well balanced at the moment. So what I've done here is this is a chart just plotting national population growth against the net additions to the dwelling stock. Now the reason why I'm looking at net additions, and this data comes from the ABS's property price series, is because when you look at dwelling approvals, completions and commencements, they only count what's added, not what's actually lost. So when obviously if you just knock down a home and you build a duplex, you're only adding one to the housing supply. So this data here, it doesn't go back as far, it only goes back to 2012, but it actually shows the net addition to the housing stock. And what this chart's showing is that nationally it's pretty well balanced. The population's grown by 390,000, grew by 390,000 in 2017, and that's versus a 185,000 increase in the dwelling stock. So, I guess in some ways you'd probably argue it's slightly been oversupplied at the moment, given its ratio of about 2 to 1,
Okay.
Population to dwelling increase. But a lot of that is high rise, so they can't take as many people, theoretically.
Yeah, because it's a commonly trotted out excuse is the lack of supply and into house prices. I guess this is evidence of the contrary. Yeah,
well, I mean, certainly in numbers terms it is. Look, I do buy into the supply argument when we're looking at land values and scarcity of land. But when you look at actual physical building numbers, I can't make the same case. It's pretty. It's a fairly balanced supply market at the moment. It's probably but again there are differences throughout the country.
Yeah, and we spoke before last time about it, just saying given the total stock of housing is sort of like 5 million type thing, it takes a very very small change in the percentage in the number of people per house to all of a sudden make a big difference. You just need a bunch of a few more people, a few more kids sticking around with the parents a little bit longer. A few more people with shared flatmates, a couple of holiday houses turned into normal houses, and all of a sudden that supply issues aren't there. And I'd probably say Perth, the stats Leith was talking about, Perth are a little bit of a good indicator in terms of that, but because a lot of those is about saying, well, your rent will hold up because we've got this great population growth and all that type of stuff. But if the population, we're dragging lots of people in, but Perth's sort of seeing the other side of that. If you're not actually
Now the mining boom's over, everyone's leaving, and the tide's going out.
That's the key, is that it's a broader economic question. Like you have to have a stronger economy to support
more people who can afford.
Yeah, precisely. So if the broader economy weakens at all, then you start to see that denominator move, and you can shift into oversupply really quickly, which is
Yeah.
what happened in Ireland, Spain,
Ireland,
California.
Yeah, California was a classic. The California actually is a bit like Sydney. It has actually got a structural undersupply problem. So they've got massively tight land market, geographical constraints like mountains and sea and all that sort of stuff. But in the run up to the GFC or that US housing bust, there was just everyone was screaming shortage. And then when the economy turned down, suddenly more kids stayed at home, more people went into group accommodation for rent. And then suddenly it got thrown into an oversupply, and that's purely because, as Damien said, we've got about 10 million homes in Australia. You only need a small fraction of people to stay at home for longer, or to move in with friends and do share accommodation for suddenly to be an oversupply. So, demand is changeable as well. It's not just about supply, and it does depend a lot on economic conditions.
Okay, very good. Looking now at commitments versus dwelling price growth.
Yeah, so the next few slides here or charts are really just looking at the immediate indicators. So the sort of current indicators showing the outlook for prices, and again, like the ones you saw before, they're actually very poor. So the first chart here, what I've done is I've tracked investor mortgages against dwelling price growth, and the reason why I've used investor mortgages is that the correlation is actually higher than just total finance. Anyone who's watching these slides live will see that there's incredibly strong correlation between dwelling price growth and investor finance commitment growth. So as one rises, the other one rises, one falls, the other one falls. And at the moment, investor finance commitments are falling very hard. As I said earlier, they were down 7% in the year to May, and that's a pretty ominous indicator for house prices. And it's one of the reasons why prices are now falling. And there's a whole lot of policy reasons behind that, which we'll get into later. But that's just the chart that's worth the metric that's worth bearing in mind there.
And I don't know if I'm reading into that. It'd be interesting to do the statistical analysis, but it does certainly look like the investor finance stuff. The investor finance increase actually lags prices on the way up. So prices rise and then investors all start getting going on it. But it seems to lead it on the way down in terms of or at least very much coincident on the way down, in that when investor finance falls away, house prices suffer.
Yeah,
whereas on the other way up, it sort of seems as if it's almost there's slight, prices start rising and then everyone starts piling in.
Yeah, and I think this chart's probably bearing that out to a degree. If you look back, it does look like dwelling prices did lead it a little bit on. We're talking 20 years ago or even to 10 years ago, but now since in the most recent cycle, it's probably gone the other way. But yeah, there's definitely a strong correlation there, and you could say one's leading the other, but the fact of the matter is both prices and investor finance commitments are falling, and that's not a particularly good sign.
The last couple of cycles. Investors have followed first home buyer grants, so prices got moved initially by first home buyers, certainly in 2008-9, and then investors piled in behind that. But this cycle's fascinating in that it's the first time you've got a complete divergence between the two. We got first home buyers, which we'll get into a bit later, holding up, but the investor component crashing, which is quite unusual.
Okay, very good. So we'll roll into 5 city. So this is the 5 city sales volumes over price growth.
Yeah, so this is like the similar chart. Volumes seem to, match prices or lead prices in some instances. So we mentioned before that sales volumes have tanked, but this chart actually tracks it against the dwelling price growth, and you see that there's like finance commitments, there's a hell of a strong correlation, and that the collapse in sales volumes doesn't augur too well for prices. Yeah,
well, the interesting part here is obviously there is that strong correlation, and obviously it could be an anomaly, but the right at the end there, where we've just had this last hurrah perhaps of house price growth against falling volumes. Like, is that just the top effectively, where things are just hitting the bid and off we go?
Yeah, that was actually a similar phenomenon happened with finance as well. And what at the time when I was looking at this and scratching my head, because it was just it was a massive break from trend. Put it down to probably a big boom in foreign buyers at the time, who for at least with respect to finance commitments, and I'm not as sure about volumes, a lot of them were paying cash and weren't using the financial system to purchase property. So they were pushing up house prices without it being reflected in mortgage credit. But now, obviously, the foreign bids disappeared. So now it's reverting back to trend, back to the relationship. So if you actually went back a chart, you'd see the similar kind of relationship there between finance commitments as well. It sort of went out of whack for a bit, and then that's caught back up.
Okay, sure thing. So that wraps up the national perspective, and now we'll roll into Sydney. And we've got here an interesting chart that I guess effectively breaks up the Sydney property market into thirds. Would that be right?
Yeah. So this part of the presentation will focus on Sydney and then Melbourne. The reason why I'm focused on these two is obviously they're the biggest. They comprise 40% of the nation lives in these two cities. It accounts for probably about 60% of the nation's value, the dwelling values, and it's obviously driving the cycle at the moment. This is pretty interesting about Sydney. So in July 1, 2017, the state government in New South Wales as well as the Victorian state government both brought in first home buyer stamp duty concessions. And basically this has juiced demand at the affordable end of the market, and it's actually helped to hold up values, but it hasn't saved the market at the higher end. And
it's a classic demonstration of stupid policy.
Yeah, absolutely ridiculous.
The affordability measures made all the affordable homes less affordable.
Yeah, that's right.
While everything else gets cheaper.
Yeah, that's right. Just throw the first home buyer patsies to the wolves. It's basically what's happened. But so what I've got here, what this chart shows, this comes from CoreLogic again, and it actually tracks the three bands of the market. So it's got the top 25%, so the most 25% most expensive, the middle 50%, and the bottom 25%. And what that shows is that it's actually the top end that's falling the hardest in Sydney. So over the most recent quarter, so the June quarter, the top 25% in Sydney fell by 1.4%. The middle 50% fell by 1%, whereas the bottom 25% only fell by 0.6%. And the chart does show that the top end tends to rise more during the boom and fall harder during the bust, and that's exactly what we're seeing now. And of course, as I said, the lower end's been held up by these first home buyer bribes.
The divergence though that's greater in this dip than earlier cycles is, again, you could put down to foreign buyers, couldn't you?
Yeah, certainly. Leaving the high end market, as well as obviously the first home buyer bribes propping up the lower end of the market. So it's interesting.
Okay, sure. And we'll roll into some investor finance specifically for Sydney.
Yeah. So as I said earlier, at the boom, investor finance accounted for about 60% of Sydney's mortgages, and it's now fallen to about I think it was 54% the last time I looked.
And that's been in response to macro-prudential or...
Yeah, just also partly a pickup in first home buyers as well because of policy changes, but also just the investors leaving the market. And but either way, investors are the key driver of the Sydney market. So what I've done is I've plotted investor finance commitments against dwelling price growth. And like the national picture, it's incredibly strong correlation, and investor finance commitments in Sydney are falling pretty hard. So they fell by 6.4% in the year to May, and that compares to a 10 to 20% growth during the boom. So investor finance is falling versus very strong growth during boom times. And again, this just points down further for Sydney house prices. It's another negative indicator.
Can I just make a point on that chart too? If you look at the post 2003 boom and bust, and you had the long shakeout for investors in the Sydney market, and that's the period over which Sydney prices either fell or went sideways. Definitely fell in real terms for quite a long period, all the way through, which just underlines that the investor bid is the marginal price setter for house prices, which is the point Leith is really making. They've got access to more finance than the first home buyers, so they're the ones that bid up prices.
And tax deductions?
Yes, quite. And so they're the ones that really set the prices when they're rising, and then on the downside as well.
Okay, sure. Excellent. Looking into sales volumes over price growth.
Yeah, so this is like the one I showed earlier for national picture, but it's just another one, separate one for Sydney. And again, very strong correlation between volumes and prices. And Sydney's sales volumes are down 35% since the July 2014 peak. and they've actually crashed to close to the lowest level in 20 years. So again, it's another bearish indicator for Sydney property. And it's also very negative for the state government, which is extremely reliant on stamp duty receipts.
Okay, sure thing. And then we'll look into the supply, as we looked at before, at a national level, now at Sydney.
Yeah, so supply in Sydney's pretty well balanced. Sydney added 115,000 people in 27. Sorry, this is New South Wales, because the data only exists at the state level. New South Wales added 115,000 people in 2017 versus a 50,000 increase in dwellings. So that's a ratio of 2.3 people per new dwelling, which is a bit less than what the existing what it is for the overall housing stock, which is about, I think, 2.6 or 2.7. But the reason why I'd say it's pretty well balanced is that a lot of the dwellings being built now are apartments, so they, in theory, can't hold as many people as what the existing housing stock can, which is more detached houses.
And but obviously still register as one housing unit.
That's right.
Yeah. Okay.
Yeah. So just looking at net additions. So that's net additions again, which is construction less demolitions.
Okay.
So it's actual additions to the housing stock.
Sure. All right, very good. And then on to some rental vacancies. We haven't had these yet, so
yeah. Well, this kind of contradicts what I just said about it being well balanced. It's probably actually I'll take that back. It's probably slightly oversupplied. Is probably a better way to say it. Sydney's just hit the highest rental vacancy rate in 13 years, according to SQM Research. So, SQM Research just earlier this week released its rental vacancy data for June, and Sydney's rental vacancy hit 2.8%. So it's above the national average, and it's the highest in 13 years. And Louis Christophers, who's the head of SQM Research, came out today and said that he thinks Sydney's going to top 3% rental vacancy rate by the end of the year.
Wow.
So yeah, supply is lifting, which disregard what I just said about it being well balanced. Sorry, slightly oversupplied.
Okay, sure thing.
Again, I'll just make a point about the 2003 to 2007 correction in Sydney, when rental vacancies were much lower and fell through the period, and that actually led to a huge boom in rents.
Right.
In Sydney, driven not just by low vacancy rates, but also by very high income growth, owing to the mining boom. As you know, you can't leverage rents, so you need income growth to really lift them.
Sure.
But the big rental adjustment that transpired over that period was one of the price corrections that sort of backfilled the bubble post 2003. So rather than headline prices falling so far, rents rose to meet the headline numbers, and therefore reduce the multiples and make an adjustment that meant that the market was more affordable, or at least made more economic sense. This time, with a rising vacancy rate, at least for the time being, that's not possible, and so you have this scenario in which you might have falling rents and falling headline prices, and both of them chasing one another. So the adjustment has to be much more at the headline level.
Yeah, and look, it's also a nightmare scenario if you're a Sydney investor, because not only is the value of your asset falling, but your rents that you're going to command are going to fall, and this is exactly what we've seen in Perth. Obviously, Perth's had it for years and it's a lot deeper, but it's the start of what we've seen in Perth, where Perth's dwelling prices are down 12% in nominal terms, but its rents are also down 25%.
Wow.
So if you're an investor, that's a shocking scenario. You're looking at capital losses if you bought recently, and you're also looking at your income losses as well.
Yep. Okay.
So it's a pretty bad situation.
And often new apartments also have rental guarantees on it from the developer, which so sometimes this is delayed in terms of the effect, where you've been given a guarantee and so even though people who are in the market and they've gone, I bought something 2 years ago and it had a rental guarantee of whatever 5% until for that is as they roll off, they start finding out, well, that's actually not the market rent. Yes, you got a rental guarantee for it, but 2%. But now you're taking a cut on the on the rent you're actually getting.
So and I guess the flip side of that is that from the numbers perspective, potentially rather than being a cliff, there'll be like a lift in vacancies as these large, like say we've just obviously had this big apartment boom in Melbourne and Sydney, and there'll be these guarantees that'll be dropping off, and then the market will hit, and then what will happen then? So essentially that will come into the numbers as a higher vacancy rate, or rents will fall.
Well, I think in the end, coming back to David's point, is to me it's what are wages doing?
Yep.
Because given that thing about the such a large denominator of houses and the vacancies being a pretty small element in it, and you just need to have a few more people in or a few more people out, a few extra flatmates, is that if you've got strong wages growth, as we did over that time, then you get strong rental growth, and that sort of feeds back in. But if you haven't got the wages growth, then it's very, very hard to see any rental growth coming out, even in tighter markets.
Yeah,
okay.
You can't leverage rents.
Certainly not. Okay, very good. So that's it for Sydney. We'll roll across down into Melbourne.
Yes.
And we'll kick off with Melbourne dwelling growth. I've got a couple of questions here as well, but I might just wait till we're finished with the two cities, and then we can jump into some general questions from the audience. So
yeah, sure. This won't take too long. I'm just basically going through the same slides as did for Sydney. I'm doing for Melbourne. So again, we're tracking the so the next chart here comes from CoreLogic. It tracks the quarterly dwelling value growth across the three tiers, so the top 25%, the middle 50%, and the bottom 25%. And as I mentioned earlier, Victorian government also brought in first home buyer bribes, stamp duty concessions in July 1, 2017, and this is helping to hold up the bottom end, which has actually increased by 0.4% over the last quarter. So that's against the whole market falling by 1.6% in Melbourne. The middle 50%'s fallen by 0.8%, and the top 25%'s fallen by 2.3%. So again, it's the top end which is taking the biggest hit, whereas the bottom end's actually helping to hold up the market, due largely to these policy bribes from the government.
yeah, well, and it certainly looks like the Melbourne high value properties are more pronounced in the ups and downs than say Sydney. Is there sort of any real reasoning, do you think, versus Sydney on that one? I'm just in terms of the highs and lows, are dramatically higher in the boom time, and obviously falling a lot harder in the downturn. I'm
purely guessing here, but Melbourne has been the epicentre for foreign buyers. So, but this is really just a guess, because we did see it spike in 2015, the high end particularly, and that I think associates with the peak in the foreign buyers.
Okay.
According to the NAB slide I put up earlier. So that's just a guess. It's an educated guess, but I can't say for sure.
Okay, sure thing. We'll jump across now to investor commitments for Melbourne versus dwelling price growth.
Yeah. So it's a similar correlation, very high. Not quite as bad as Sydney, because Melbourne's investors in Melbourne are still the marginal buyer, but they're about, I think, 45% of total mortgages. And investor finance hasn't fallen as hard as in Sydney, but it is trending down pretty strongly. And
actually, just putting that in context, is that I think it's about 70% home ownership rate, isn't it, for Australia in terms of, so 70% own your own home and 30% investors?
No, it's actually closer to, I think, 64 or 65 now. It's fallen pretty heavily in the last few census. Okay,
but I guess where I'm trying to get to there is that you're 45%. So let's say 35% are investors in the market and 65. So still in finance, it's still actually well overweight, in so to speak. Like over the long term, you'd expect roughly the finance from homeowners to be 65% and from investors to be 35%. But when it's running at 40, if investors are running still at 45%, it's still actually they're running well above their ordinary punching weight.
Yeah, I to your point, I probably I wish I put it in the chart, but I track it as part of the Housing Finance Series, investors by jurisdiction, and New South Wales is way out in front, followed by Melbourne, but they're both way ahead of the other jurisdictions. So they're both very much overweight investors. It's just that Sydney's even more overweight. But what this shows is that investor finance growth's falling. The trend's falling pretty hard. It did rise by 0.1% in the year to May, but it's coming off pretty strong, and that's versus 5 to 10% growth during the boom. So it's just another negative indicator. Skipping along to sales, again, this is another iteration of the chart I've shown previously. Melbourne sales are falling quite sharply, and this is helping to drag down prices. Again, there's a very strong correlation It hasn't fallen as far as Sydney, but it's certainly on its way, and it's falling very steeply. Melbourne sales volumes are down about a quarter since the August 2015 peak. So just another negative indicator. And then shifting along to supply. I can probably say, I said Sydney's well balanced. I probably should have said Sydney's slightly oversupplied, but the supply is certainly tighter in Melbourne than Sydney. So I'd say it probably is fairly well balanced in Melbourne. So Victoria, not Melbourne, but Victoria, which is mostly Melbourne, had 145,000 increase in population in 2017 versus a 56,000 dwelling increase. That's a ratio of about 2.6 new people to dwellings, which is about what the city average anyway. So it's kind of marking time, but again, if a lot of that's apartments, theoretically they can't hold as many people as the existing housing stock.
Okay.
And this helps to explain, go to the next chart, why Melbourne's rental vacancies are a lot tighter. So I've got a chart here from SQM, and it basically shows that Melbourne's rental vacancies back in the early 2010s were tracking at about 3%, and they've fallen to about 1.6% now, and that's below the rest of the nation, or the national average 2.3%, then excluding Melbourne's 2.8%. And part of that is also because of Airbnbs. Melbourne's the Airbnb epicentre. And there's been a lot of reports about a lot of homes have been taken off the rental stock because a lot of them have been used as Airbnbs.
Airbnbs, yeah, sure.
I've got a bit of anecdotal evidence. My dad lives in a freshwater place, a high rise in Melbourne, and he constantly complains that the apartments there have shifted from renters or owner occupiers to just massive amount of Airbnbs, and it's driving him nuts. And so that would artificially push down the rental vacancy rate.
Yep. Okay. Sure thing.
More terrific policy.
Yes.
Absolutely. I'll jump across maybe just before we move into policy responses into a couple of quick questions. So we've got one here that looking at long-term cycles in property, do you guys think we'll ever see a 20-year bear market in property?
Well, I do.
Yep.
Yeah, I think we're entering one.
Right now?
Yes.
Yep. This is it?
Yeah. Largely because the props, the major props to price growth are running out of petrol.
Yep. Or being taken away.
No. Well,
We'll also push the limit.
They're actually structurally inhibited. So monetary policy we're close to as low as interest rates can go.
Debt's at a high.
Household debt is extreme. Fiscal policy which kicks in and supports the bank's offshore borrowing, in down cycles is going okay, but is definitely on the sort of skirting verges of downgrades. The other major policy prop is immigration policy. Now that's strong for now, but you'd have to be deaf and dumb and blind not to see the political pressure that's coming to bear on that. I'm not sure how long that can be held at these levels. And so I think the foreign buying phenomenon is done as well. Of course you can't say for certain whether that won't return, but for the time being at least, China's got enough troubles of its own that it's going to restrain capital outflow.
Credit was incredibly loose, and it's can't see it being as loose going forward.
Post Royal Commission, the distribution of credit's going to be much tighter structurally. So
policy negative gearing capital gains tax reforms.
Can I throw something in?
Not yet.
No,
let me finish.
Hang on. Remember we've got policy responses as well.
So I could see a scenario in which we have a very, very long bear market. I mean, it might start with a bit of a shock, and we have enough of a fall in prices to shake psychology, and then we manage to sort of bumble our way back out of it with some quantitative easing and pulling the levers that we have at our disposal, get a lower dollar and what have you. But even in those scenarios, we're so income constrained in the structure of the economy that we have, even if it's driven by even if you persist with immigration, that I can see I could see property falling in real terms for 20 years, sure.
Yep.
Well, in some ways, we've actually had it outside of Sydney and Melbourne for almost a decade.
Yeah.
I mean, the other markets of after inflation are actually going backwards.
Yep.
So you can argue that their valuations have actually fallen when you put them against incomes, GDP, gross state product, etc. So it's really Sydney and Melbourne have been driving this the last since the GFC. They've driven the boom. Brisbane, Adelaide, Perth's gone backwards. Brisbane's gone backwards a little bit after inflation. Adelaide's done nothing. I'm not sure about the minor markets, but so we've kind of already seen that outside of Sydney and Melbourne, and there's no reason to think that we couldn't have the same thing all over again, whereby housing gets slightly more, gets the valuations against the things that matter fall over a period of decades.
Yep. Okay. Fair enough.
It doesn't necessarily have to be on the nominal level.
Well, we've got a bull chomping at the bit.
Yeah, we'll better hand over to Damien.
no,
Everyone wants to go at this question.
Yeah, that's right. Well, as the joke is, living in Australia, you get to one of the benefits is you get to live with 25 million other property experts. But I mean, I think for me the big issue there is the 20-year thing. 20 years is a hell of a long time.
We're just guessing.
And the thing is, it depends on how. To me, the big question is how sharp is it? And because if it's a long drawn out, if the idea is that we're going to make a lot of policy. There's going to be a lot of policy thrown at it to try and hold the housing market up, then I think, in real terms, a 20-year bear market where we're sort of, as you said, a slow grind and everyone tries to keep house prices as high as they can. But the flip side is something cracks and gets out of control and you see some, 10, 15% house price declines in short order, which is, analogous to what you've seen in a lot of other markets. Then from that, then I think sort of you've got a short, sharp 2 or 3 year housing bear market, and now you're off, in the grind upwards again. So really, your end point might not be different. But if house prices fall say 20%, then I'm saying, well, that's it. The bear market's over. Don't wait around for 20 years going, it's not going to happen. It might from point to point in real terms over 20 years you might not make any money or much at all after inflation. But if you're buying at after that 20% fall, then it's not a bear market for you.
Yeah, okay, fair point. And I guess, and the other side too is that there's obviously going to be listeners that are thinking from a homeowner sort of perspective, and then thinking from an investment point of view. And I suppose it's about working out, well, is there better opportunities for investment as opposed to do I want to continue being a renter and having the short-term sort of nature of Australia's rental market thrust upon me as well and my family?
We're not going to. And there's a lifestyle. There's lifestyle, and you can't mix the two.
Yeah,
You need to make a decision. If I want to buy, reading up. There's lots of horror stories already starting coming out after such a small fall of people buying places and stuff like that. But the question is, if you've bought a place for X $1,000 and you're paying for it and you're still living in the house, then what do you care and you're going to live in it for the next 10, 15 years, what do you care whether it's fallen or not?
Yeah. Look, I mean, I'll add to that. I'm a home buyer and blah blah blah, and homeowner, have been for over a decade, and I want to see prices fall the next 20 years. I've got 2 young kids, and one of them's 10, one's 7, and in 20 years' time, if you have a 20-year bear market, fantastic. It means they'll have a chance.
Yep.
I'm exactly the same. I completely agree.
Yep, fair enough. All right, in the interest of time, we better jump across to policy responses. I've got a couple of questions, but I might wait till we've finished with the monetary policy part, because the question pertains to that. So who wants to dive in on this one, David?
Yeah, well, I mean, the obvious save that could come into the market is the RBA cuts rates again.
Yep.
It's on record saying it doesn't want to go below 1% at any point, so that only gives it 2 rate cuts. You could argue it could go lower, but let's go with what they've said. So, the last time they did 2 rate cuts, it sent the market nuts again for about a 15%.
Oh, it was big.
Turnaround or something, pop, and then they tightened macroprudential and popped that second round bubble. If the RBA cut, then I would expect some kind of rally to transpire. I think it'd be much more mooted this second time around because lending standards are so much higher now than they were. Not to say high enough, just way less low.
Yep.
So we're also very late in the cycle, and I think probably the key point to make is the RBA is not going to do it yet. They wouldn't do it, I don't think, until Sydney and perhaps Melbourne are down 10%.
Right.
And the critical factor will be that there'll need to be contagion into the broader economy. I mean, if by some miracle they manage to support the economy with fiscal spending sufficient to offset what will be most definitely a retrenching consumer that are chasing those prices down, then the RBA won't cut at all. And you could actually see a genuine fall in prices. So it's a high bar for the RBA to cut, but I mean, I'm on record saying I think that they will be forced to. And when they do, I think there'll be a rally, but I don't think it'll be anything like we've seen previously, largely because macroprudential is still there, and post-Royal Commission, etc.
It also depends on mortgage rates too, because the banks could hold back some of that cut, and
they could, they would.
Yeah, that's right. And their funding costs are rising, so we don't. Depends how much actual mortgages we get.
That's right. So there wouldn't be that much relief. So I wouldn't expect it to last long. I would actually think that it would be a temporary relief and roll over again.
Okay, sure. So I'll jump into the question there. So the question was relating to will we ever see negative interest rates to a point where debt holders are paid for their mortgages and savers are punished? And I guess just relating to a broader trend of negative interest rates, high debt and high deflation pressures. So we're going to go the way of...
the 1970s?
Yeah, well, essentially, I guess, yeah. Well, I guess a question on whether it's in real terms or not, but...
let's assume on real terms. I think in nominal terms we'll all say no. That's the answer. But in real terms,
well, I mean, basically what happened in the 70s was, my parents often say, we paid 13.5% interest rates in the 1970s, and I always
pay $4.50 for your house, though.
Yeah, no. But always, my response is always yes. But inflation was running at 21%.
Yeah.
So
and wage growth was 10, wasn't it?
No, it was 21% as well. So that's a real negative interest rate, and the only way I think we could get to that is if they dropped, the cash rate to as close to zero as they can get. The banks, passed a lot of that on, and then we had inflation pick up, because with inflation running at roughly 2%.
Wage inflation. I'm going to preface that by saying wage inflation.
No, fair enough. Yeah,
inflation's not going to be enough on its own.
Yeah. So look, I mean, it's possible, but I don't think it's
very difficult.
Yeah, very difficult. It wouldn't be anything like the 70s when you had like 7% negative interest rates.
No. And this is the problem, isn't it? I mean, this is why it's so difficult to get out of this balance sheet, overloaded balance sheet problem that we've got. Is you just can't get
inflation.
Wage inflation up enough to make a difference,
and you need it to inflate the debt away. So basically, all the adjustment now is in previous corrections in the 80s and 70s and whatever, prices did fall in real terms, but it was on the real side because of inflation, not the nominal side. Whereas now the adjustment's got to come nominally.
Okay.
And sorry, I'd like to, put a disclaimer over that, is that you can't get inflation with the tools we're currently saying we're going to use.
Yeah.
It's not the fact we don't know how to cause inflation. Inflation's easy to make. We just print money. But there's a lot of constraints put on central banks and government budgets in terms of saying no, you're not allowed to, and so it's got to be this sleight of hand QE type thing that's going on. And Japan's central case for that is that if you're just using those same tools and trying not to print, then 20 years later you're still in the same position you were.
Okay, great point.
Never say never.
So just finally on the fiscal policy and tax policies in response.
Well, macroprudential, I should cover that briefly as well. It's still tightening. As when APRA removed the 10% investor speed limit for each bank, they weren't allowed to lend more than 10% growth on their investor book. They lifted that a few months ago, but they put instead in place a regime of it wasn't LVR, what was it, debt to income, I think, limit 6 times, debt to income limit. It's not a hard limit, they're internally managed limitations that APRA will oversee, but these are much lower than a lot of the bank books have currently got, and so they have not responded to the removal of the investor speed limit by lending more to investors at all, because they're still busy trying to figure out how to get around this new limit, which will actually probably force them to tighten even more on investors, because they're still out of the money they're still way over leveraged in terms of where APRA wants them to be. So that's what we call macroprudential 3.0, and it's probably still going to be tightening, not loosening. And the other macroprudential feature, of course, is the Royal Commission. We're still not sure what that's going to rule on it's going to demand, especially in terms of, assessment of income and expenses for the banks and the use of benchmarks versus individual, expense categories and policies for the banks. The banks have all moved in advance of that to create greater granularity in the way they assess these things, and I can't see that going backwards. It'll probably only get stronger after the Royal Commission brings down its findings. So macroprudential will remain tight, I guess is the point.
Yeah, just on that, just today, which is Thursday, the 19th of July, there was an article in the ABC about how Westpac's copping a lot of heat because it basically lent a borrower, a couple of $1 million based on their household expenditure measure of their expenses, and this is one of the problems. The banks have been using this minimum benchmark called the household expenditure measure to measure everyone's expenses, and the Royal Commission's basically caught a lot of them out, and they've now been forced to, as Dave said, take into account people's actual expenses, which are a lot higher. Gee, surprise, surprise. But this has copped a lot of heat. There's another one today about it. This so-called predatory lending and not bothering to do the proper due diligence and credit analysis, which is what banks are meant to do.
This tips into liar loans.
Yeah, liar loans, all that sort of stuff. And I can't see that going backwards. It's just they've been caught with their pants down.
Can I give you a scenario where it'll go backwards? Is the next, we've got another 6 months or so, haven't we? So the banks all get their, we're straightened up. We're not, look at all the lending we're doing, isn't this responsible? APRA, hey, look how responsible I'm being. You don't need to put stuff on that. Yeah, those last guys who are running the place, they did a terrible job. But we're much more ethical and all that type of stuff. We don't need these things. The Royal Commission comes out, hands down a list of these are all the things it should do. And the federal government goes, yeah, that's going to crash the housing market. We're definitely going to do those
soon
when we get around to it. Yeah, we just have to get a few things in order first, and then we'll do it.
Yep.
And so,
you sound like a macro business reader.
There's your scenario that ends up being, we know what needs to be done and what has, and to sort it all out. But I guess what I'm saying is, I'm not completely on board with the fact that.
It's all changed.
I'm morally on the board with you guys, but I'm not completely on the fact that practically that's what's going to happen. Because we would have said the same thing 10 years ago about the money laundering stuff and money laundering into Australian housing, and here we are 10 years later with still excuses about we just need one more review. We haven't asked a few people. There's a few more Australians left we haven't asked about this. So we need to go and ask those guys first.
Yeah, fair enough.
Yeah, no, that's fair enough.
Well, that said though. These changes have been made.
Yeah, by the banks.
These are not mooted changes. They'd have to be undone, right?
Yeah.
So we're not.
But I think the banks are probably being a little bit stricter now than
I agree.
They're straightening up as much as they possibly can.
Yeah.
Once the blowtorches.
Of course. Once you get past the crisis, most definitely they could loosen off a bit. I mean, I had a conversation with a developer last week who. Had a 20-year relationship with CBA, and he had half a dozen developments going at once, and he had to split between 3 or 4 different banks to get them funded, because the CBA hadn't even set its lending policy post Royal Commission for his segment, right? So they were just completely stalled out. Yeah. Not because he necessarily didn't qualify.
Yeah, but that's supporting me.
No, I am supporting.
Yeah,
that's the
supporting
point.
my view that things are tight right now.
Yes. No, that's what I'm saying. I'm agreeing with you that it can loosen from here, definitely. But nonetheless, there has been quite a tightening,
and certainly relative to 3 or 4 years ago.
Yeah,
absolutely.
It's there, and monetary policy is still close to exhausted.
Yep.
So anyway, moving on.
Sorry, go on. Yeah, fiscal.
Fiscal. Well, we've got, the first home buyer grants going already in the major markets. Sydney and Melbourne. I guess that if it really push came to shove, there was an offshore shock, the Feds could maybe double them, as they did before, and that might deliver some short-term support for the bottom of the market. But again, unless you're going to follow through with some gutting of the raised lending standards, investors are really going to struggle to pile in behind that. So I would again see that as a short-term fillip that isn't going to last very long. And then finally, tax policy. I guess the key there is.
We've got a number of fronts. I guess one's obvious is the negative gearing changes
Labor's
proposed
policy and CGT.
by Labor,
but
CGT.
also SMSF lending, which Westpac's really shocked the market this week by pulling out of SMS lending.
I question whether or not it's that commonly used as well. Though I think it's one of those things where you can say you're removing it for probably the reasons Damien said. Okay, I'm going to tidy up my books a little bit. An example was removing the fee for using other ATMs, and if you actually look behind the numbers, no one's withdrawing money anymore. So it's a bit of free kick news there, I think. Perhaps potentially.
Well, that may well be the case, given investors have been knocked on the head pretty hard. Nonetheless, they're not going to do it, and CBA is the only bank left in the market of any substance that is doing it.
Yep.
And they may well be forced to follow Westpac.
Yep.
I mean, you got to ask yourself why now. It might be, as you say, the demand's just not there, so it's an easy one. But it might also be part of the interest-only reset issue. Like, how much capacity have they got to make these interest-only loans, and what components of that repricing transpires in the front book versus the back book, and do they have enough capacity to service the SMSF guys while they have to roll over so many in the reset? Like, these are all unanswerable questions right now. They're uncertainties, but certainly it's we haven't even talked about the interest rate reset yet, but that's just another very opaque negative that's sitting over the market. But the key one in tax policy is negative gearing reform. I'm not as confident Labor are going to win the election as I was. I think that the coalition is sort of slowly climbing the slippery slope of One Nation. Through its various lies about cutting immigration.
Thanks for that mental picture too, by the way. But anyway.
I didn't say Pauline Hanson. I don't know what's going to happen anymore. It's looking more and more like it might be an even money bet.
And if house prices are down, then
will Labor
well, the thing is, if they do cut immigration, then I think they're going to win. If house prices are falling, then
they could big scare campaign.
Major scare campaign around negative gearing reform, and I think they get over the line. Quite frankly, and I guess the thing is, if they're sort of building towards some sort of immigration cut by pretending to cut, you've got Tony Abbott, jumping up and down as well.
Dean Smith, and there's a couple of other senators.
And the rhetoric alone seems to be working to some extent to bring back, the splintered Conservative vote. At least, the anti-immigration voters in One Nation get some comfort, obviously, from the coalition, from that rhetoric. If it's not enough, then they probably will have to make a decent material cut to immigration, and if they do, I think they'll win the election. So I'm not sure that that's such a negative anymore. Well, it certainly will be if it transpires, but it's not as clear cut as it was.
Yeah, and even if Labor does get elected now, they've committed over and over again to restrict negative gearing and halve the capital gains tax discount, but by the end of the year, Sydney's dwelling prices could be falling. The falls could be approaching 10%. It's already at 5.2 or something. It could be 8% by the end of the year, and by the time the next election is, they might have fallen by 10%. It's going to be a lot harder for them to justify cutting negative gearing into a market that's down so far.
With falling rents as well.
Exactly, falling rents as well. So, it's great policy, but it might come at exactly the wrong time. They might have to go,
It could be bad politics.
That's it, bad politics. And as Damien said, they might just go, we'll delay it. We're still going to do it, we're just going to delay it for a year. And then, like the money laundering stuff, and then 5 years down the track, we're still waiting. Just
one quick one, and in interest of time, we'll get moving, a couple to go. But the on tax policy, thoughts, if I throw this one in the mix, of potentially lowering taxes to create effectively a pseudo wage growth, solve that pseudo wage growth problem that we have. Do you think there's an advent of a tax cut to help juice demand, perhaps, essentially?
Well, it is in the tax package.
It's all the high end.
It's all, I was going to say. Well, obviously it'd have to be fairly broad based.
Yeah, that's where the investors are anyway, aren't they?
Yeah, well, that's the thing, because obviously if you're lowering the tax rate, then you're lowering the impact of negative gearing. So it's sort of, I guess they sort of work in lockstep a little bit, but then obviously you're wrecking public income revenue, aren't you? So is that something that do you think you'd ever see that on the horizon? Is that a lever that might be pulled?
I mean, the only way they could do it, I mean, I don't think they will do it, but the only way they could do it is if they abandon the company tax cuts and instead, put that money towards, broader tax cuts, which the coalition's already sort of muted.
Okay.
But they don't come for a long time, most of them, and most of it's at the top 20% anyway.
Yeah, right. Yep,
so it's, the very people that have a low propensity to spend, or they have a high propensity to save, they're less likely to spend their money.
I'm afraid the opposite is probably more likely.
Right.
I mean, whatever tax cuts we get through in the next couple of years are more likely to have to be reversed.
Yeah.
Once, China's growth will continue to slow. Whether it happens fast or slow or up and down and whatever, in trend it will slow, and their commodity demand is going to fall. So, prices have not bottomed in commodities, and that's the key input into national income and the budget revenue. And once we get back there, then these lovely cyclical tax cuts funded by structural tax cuts funded by cyclical upticks in commodity revenue will look very stupid.
Sure. Yep.
And so we'll probably have to raise taxes again.
Interesting. Okay, we'll jump into one of the other, I guess, government policy responses near and dear to the heart of the MB following, which is of course, the ability to just open the taps on population.
I think it'd be electoral suicide to do it now. I mean, the last five most recent opinion polls have shown overwhelmingly that Australians want lower immigration. And in fact, if anything, they've strengthened. So we've had 5 over the last 6 months. Australian Population Research Institute, Guardian Essential, a couple of news polls, and Australian Population Research Institute, I'm not sure I mentioned that one already, but the most recent one came out last week, showed 3/4 of people supported the coalition's so-called immigration cuts, and the level's been increasing. So,
but isn't that the point? Isn't that hey guys, look over there, look over there, look over there, and
but
population keeps ticking up. But
I don't know if it can. It's actually fallen. That I think that chart might be a little a quarter too old, but the population growth's actually fallen a little bit again. So it did get up to 400,000. Now it's back down to 388 or something. It's going to be very hard to increase it from here, especially given the how hated it is by the electorate. So maybe they can maintain it, but I don't think they can really just open the floodgates and get it up from roughly 400,000 to 500,000 or 600,000. I think that's be far too difficult.
You got to remember as well, there's a very strong market dimension to immigration, where you got to have jobs to draw people in. And if you look at the chart there, there's a reason immigration crashed during the GFC. People just don't move when things get tougher.
Yep.
So, given how aged the business cycle is, the likelihood is that we'll have a pretty decent downturn before we have any new boom of any kind for house prices, at least.
Yep.
The greater likelihood is that at some point we're going to see immigration fall cyclically, if not structurally. And I can certainly see the government pumping it, coming out of that.
Yep.
Especially if house prices at that point have corrected.
Yep.
They'll want to be pulling all of the levers they can. But Leith's right, it's really on the nose.
Yep.
Big time. And, it doesn't matter what pollies say now, it's the polls that matter.
Yep.
And, they're always 12 months, 18 months behind the curve. The polls are always the last to know.
Yep.
And when you start getting polling like we're getting on pro-immigration cuts, which is anywhere from sort of 55 to 75% support, that's just gold to a polly.
Yep.
Especially the Lowy one. The Lowy one, which came out a couple of weeks ago, which is close to 60%, I think.
56.
56. Yeah, I mean it's pretty close. It's all been 54 to 50 to 75, but there's 4 there which are about 52 to 56.
Yep.
Yeah.
They're all about the same, but there was the Lowy one I think that really got them between the eyes because They're sort of inside the political tent.
Yep.
The others are just like newspaper polls or Australian Population Research Institute are hated anyway. That's Bob Birrell's group, and the government just pretty much rolls their eyes when they get that, even though it's excellent.
Yeah, sure.
Yeah, that's
Okay.
right. Lowy's inside the bubble.
Very good. So we'll just might just quickly lightly cover off. We've probably done most of these answers to death, but the stiff headwinds looking forward. Kicking off with obviously bank funding costs rising. We've seen that, lots of out of cycle rises, probably plenty more to come from the sound of things.
Yeah, falling deposits, international and domestic.
Yep.
As well.
Yeah, I mean, nobody can quite put their finger on why it's happening. Deposit outflow is certainly a factor. It's lifted the demand for wholesale debt in the banks, which is not very good at this stage of the cycle. It's very bad. And we've never seen a deposit crash like the one we're seeing at the moment. Interestingly, it's driven by sort of some of the stuff that we're doing at the MB Fund, where there's huge outflows of deposits into offshore equity.
Yep.
And stuff. So, some interesting shift.
What David means by that is we're investing in we're taking money from investors usually who have it in term deposits and putting it in international equities.
Yes.
Okay.
Sorry, I didn't mean to speak Swahili.
Yeah.
But so that's causing some of it. The other thing that we think is part of it, again, is the Royal Commission. It's just when it's structurally lowered the perception or the reality, or exposed the reality of Australian credit quality is just not what it was thought to be pre-Royal Commission, and so people investing in the banks just want to be compensated for that. And so we think that's structural. We think those high funding costs are here to stay, at least until we get to the end of the global business cycle. But even then, it will probably stay higher than it used to be. So all the banks have hiked. The majors are going to have to hike.
Yep.
Interest-only mortgage cliff. I mean, that's very big as well.
120 billion or 180? I always forget.
I think it's the 180.
Yeah.
But it just runs right through until 2021, I think, the reset, because it was all interest-only through the last boom. And they're all sort of 3-5 year terms.
Yep.
And so as they roll off, the banks are going to be able to extend and pretend on some, but not all. And we've seen a very, I can't say big because it's not big, but obvious jump in major bank arrears rates already.
Yeah.
It's only not big because arrears rates are so low.
But it's still high since the 90s.
Percentage terms, it's a very big jump, but it's just that they're still, I think arrears rates are still about 1.5%, something like that. But the major banks now have the highest arrears rates since the 1990s, as Leith says, and that's giving you some indication that not everybody's able to roll over these interest-only loans.
And the reason why it matters is
we're only at the beginning of that, so that should get worse.
Yeah, and the reason why it matters is if you're on an interest-only mortgage and you go to principal and interest, your repayment levels go up by an estimated 35 to 50%. So your bill, your repayment bill rises, which obviously gives you less disposable income and etc.
Yeah, or you sell it.
Yeah, that's right. Yeah, or for sale.
Yeah,
that's a big headwind.
Sure.
And then Labor and its reforms, which it'd be a terrible tragedy if those reforms don't get up, but we're a bit concerned about them.
Yeah, it's purely a timing issue.
Yep.
Yeah.
Okay. Very good. All right.
Can I just before we jump off that page? So let's go the property bulls argument just to see. I just want to see where you guys sit. Is that because I find it interesting as well. Obviously, MB has been speaking for a long time about property markets, and most commentators were along the lines of no, everything's fine. Maybe we'll go sideways. And now markets have fallen 5%. They're saying, oh well, maybe they'll fall again for a little bit longer, but everything will be fine. But I guess the general argument goes. I'm not saying I agree with this argument, but I'm interested to see your comments, is that you go, well, look, things are a bit rough over the next 6 to 12 months while this Royal Commission stuff gets sorted out, then we'll loosen up a bit, so there'll be elements back on there. Property prices will fall. Let's say Labor doesn't get in, so you don't have to worry about those changes. Maybe the federal government start throwing a bit more money at the issue. RBA's maybe got a little bit more cuts. The funding stuff falls away, so banks can give back a little bit more. what else have we got on the thing? That
Immigration.
The immigration stays at current levels. Might not be increasing, but it's still historically very high. And by the way, the actual number of builds has fallen away dramatically, and so we're actually ending up with a bit of a shortage of houses because we're still running this high inflation, set of immigration, but the builds fall away over the next 6 to 12 months, and we're left with a bit of a hole in the future.
So you're saying that's the bull's argument?
That's basically the bull's argument, as far as I can tell. Yep.
Okay. Well, I would say that if the builds have fallen away that much,
Jobs.
you'll have a pretty nasty jobs impact.
Yeah.
And what are we saying? House prices have fallen another 5%. So you'll see quite a lot of negative consumption impact. Hard to know exactly what that means. That might mean unemployment up to 6%. Then the RBA cuts, as you say. I could see a rebound for a bit, but can you get sustained credit growth?
I don't think you can, but there's an argument that maybe something else will come along and there'll be another mining boom, or there'll be another something else.
I can't see another boom.
Yeah.
There's no another mining boom coming, but maybe there's a magical boom of some sort. We do get hit in the arse by rainbows on a regular basis. So there might be something you never can tell.
Yeah, I guess.
But I just can't see credit growth being able to rise enough with such limited income prospects.
Massive debt,
structural constraints on the banks, running out of interest rate cuts. I mean, I don't know where you get the next lift. Well, the last boom was interest only.
Yeah.
What's the next
What's
one?
next? Yeah.
Yeah, I mean, I guess.
We can let people at their super just go.
Is the next one interest and principal only? Principal. Is it free money? The next one. I mean,
we need a way to get retail super people to invest their money into.
I mean, actually, I do think the next one is
boom.
Free money.
Or negative interest rates.
And quantitative easing. I have come around to the notion that the RBA probably will end up going that way, when the rest of the world does into the next bust.
Yep.
The RBA may be forced to print.
Mm-hmm.
But when you're in that scenario, interest rates, market interest rates are already kind of running away from you, and the RBA is just trying to contain the damage.
Yep.
You're already into unprecedented territory. I'm not sure that's going to deliver you lower mortgage rates. Is the point?
Yeah, I guess all I can say is there's not a whole lot of not much upside, and there's a lot of downside risk. So that's pretty much where I'm at. I mean, with all this stuff, I've been watching this long enough to say never say never, and I believe it when I see it. But I guess all the indicators, as you've seen today, are all pointing down currently.
Yep.
But they're only short-term indicators. So. We'll just wait and see, and I guess we'll probably do another one of these in another 6 weeks or something. Do them regularly to give regular updates.
And prices will be up 5%.
And I'll be.
Have to get the cork back into the champagne bottle. Is that?
I might be sick that day.
Yeah. Very good. Okay. Well, look. We'll just roll finally into our investment impact. So obviously, the day-to-day investment team and the way that we view the information contained herein, and also obviously the other areas of the Australian market. You've got quite an interesting graph of the Australian index there, Damien, for what is it, property exposure, I guess, within the ASX?
Well, yeah. What I've done is just sort of tried to give you a look at what the MSCI Australia looks like. If you just which basically it's pretty similar to the ASX 50. It's got about 70 stocks in there. So if you start with direct property on the left, and you've got about 10% of the market sort of in whether it be things like realestate.com or REITs or developers sort of sit within that area.
Fairfax?
I didn't actually. They're not in the. They've shrunk the way out of the top sections of the market.
Oh, okay. That's a bit disappointing.
So they're not in the MSCI.
The finance sector then, sort of banks and insurers, sort of makes up that next. That sort of gets you to 50%. So I guess what I'm trying to look at is if you had a big property price fall, or even just this quite a steady growing down for a long period of time, just which are the sectors that are most directly hit first. So that sort of gets you 50% of the market. Then you go the what I'd call property dependent industrials, and these are things like your Harvey Normans and some of the discretionary retail that really when it sells. It sells based on the back of the property cycle. Something like a Bunnings, for example. People's property prices are going up. They spend a lot of money on renovations. When property prices fall, it tends to drop away. So that's sort of, and then you add in consumer discretionary, which is the more sort of exciting areas in the market, which tend to grow when the Australian economy is growing quickly. They grow quickly, and when the Australian economy is growing slowly, they grow slowly.
Sure.
So that gets you roughly 2/3 of the market. In terms of which is sort of pretty directly exposed to a property market downturn. Whether it be quite dramatic on the end of a direct property through to your consumer discretionary. So so I guess what I'm saying there is, our overall picture is, if you're looking for something to protect you from if you're worried about the housing market turning down, you're looking for something to protect you, you've either got to go to small cap stocks in Australia.
Yep.
Or you've got to take your money offshore, and that's basically the decision. We invest in large cap stuff, so we create at Nucleus we do like a core portfolio for people with all large cap stocks and large cap bonds and
the bluest of the blue chips.
Exactly. We're trying to run like the lower risk, and so we just very much struggle to find a sector that's not exposed. And the final bit, which I've sort of left off there, that goes to 80%. The rest of it's either industrials that directly sell overseas. I think of as international companies like a CSL or a Cochlear.
Yep, dollar exposed.
Or it's resources. And so the issue for obviously if some of this is based on China slowing is that area doesn't really protect you at all either. So if you're worried about property if you're worried about China slowing and a coincident property falling down, then you pretty much have to take your money offshore.
Okay, sure thing. Thank you very much for that. And I've just got one final question. I'll throw it open to the panel. And it's on the note of investing. I've just got to bring it up here. Beg your pardon. Here it is. So which, and obviously it might be an interesting answer to this, but which bank is the most exposed in terms of low doc and liar loans? Just as and this is probably almost, look, I think, well, I could throw my answer in there. I'm not even sure that the banks would know that at this point, but potentially would they?
Well, our banking insider, Deep T, calls it mega bank, and he doesn't distinguish between them. And that's probably the best way of looking at it.
Yep.
If I had to pick one, I'd say Westpac.
Yeah, me too.
Like, it's been the investor-friendly bank for many a year.
Yep.
And even over the last 18 months, as banks have tightened dramatically on investors, Westpac's been out there sailing alone, building its book versus everybody else's contractions.
Generally speaking, NAB and ANZ are more business focused.
Yeah. So
CBA might get a look in, depending. Yeah. They've been pretty good at stuffing a lot of stuff up over the last few years.
They have.
So every time somebody peels back a layer, they find a lot
more
of cockroaches.
Dead layers.
It would certainly be between those two.
Yeah.
Okay.
Yeah.
Very good. Okay. Well, look,
actually, sorry. The other thing, though, it is worth noting as well is that usually what happens when markets are running hot, a lot of the small players, they call them the lender of last resort. Whereas the first time you want to take out a loan, you roll up to CBA, and when CBA says, "No, guys, sorry, we're not going to take you," or one of the big banks, then you start down your list of some of the smaller guys.
Yep.
So there's certainly a number of the smaller banks which you really don't know. Basically anyone who's expanded quickly, you look through their book, and chances are, if people don't, the bank of first choice isn't turning up to one of these smaller banks. And so if they're expanding quickly, it's usually because they're a little bit laxer on their lending standards.
I'm not sure the big guys knocked anyone back, man.
Okay, very good. All right, look, thanks, guys. And what we'll do now is jump into some information about Nucleus Wealth. So if you're worried about the Australian property market and looking for somewhere else to invest, here's some information for you. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. So thanks very much for your attendance today, and I hope you got something out of it. I certainly did. It was a bit of a marathon webinar. Thanks very much to the three gentlemen in front of me as well. So I hope you enjoyed it, and I know that we will be bringing you further updates on the state of the Australian housing market going forward. Now, next week we are, as always, running another one on Thursday, which is entitled the Nucleus Insights Deep Dive into the Australia's labour market. So we're going to have another run through from our chief economist Leith to give us a bit of a look at how the Australian labour market's going and where we think it's headed. If you're interested in that one, head over to proton.nucleuswealth.com to register your interest, and we can keep you abreast and give you any information on that one as well. As always, we are available on Apple iTunes and wherever your quality podcasts are found in Android. Podcast Addict is one we recommend. Head over to those applications and look for either Nucleus Insights or Nucleus Wealth to find today's podcasts and also, of course, any of our previous ones. And just finally, thanks again for your attendance, and we will be sending out a survey if you have registered interest to give you a chance to give us some feedback on how we've gone today and also put forward any topics that you would like us to present in the future. So once again, it's been a pleasure to bring this to you, and I look forward to catching you at the next one. Cheers.